Good afternoon. My name is Harris Siskind. I'm head of the transactions practice at McDermott, Will & Emery. I'd like to welcome you to one of our many webinars concerning the business implications of COVID-19 and the government's response to the crisis. Today's webinar is titled, "You're approved for a PPP loan, what's next?" The SBA has approved more than $1.6 million loans as of April 16th through about 5,000 lenders. The average size of a PPP loan is $206,000, with over 85,000 loans over $1 million in principal amount. Most loans have been issued in California, Florida, and New York. Based on these statistics, these loans impact numerous businesses. Currently, the government is considering issuing another $300 billion of these PPP loans, although nothing is finalized. The rules surrounding these PPP loans and their permitted usage and forgiveness are very complex, and we put together this webinar to discuss how to appropriately apply these loans and seek forgiveness. Today, I'm joined with 6 of my colleagues who will go through the various implications and aspects of these loans. If you could advance the slide, please. They will be Sam Dewey, Lindsay Ditlow, Llewellyn Engel, James Kim, Andrew Liazos, and Josh Samus. The agenda for today and how we're divided up, and the topics are: first, to discuss the payroll cost, authorized uses, and forgiveness of these loans; FTE rehiring, wage and termination implications; the impact of PPP loans on existing credit facilities; how to acquire a business and other that has a PPP loan and other government relief plans that are available; finally, special tax and planning considerations, and then hopefully we will have time for Q&A. We have received a large number of questions prior to the start of the webinar, which we will try and address in our remarks. And if you have questions, you can submit them through the Q&A button, and we will try to get to them if we can through the various, at the end of the presentation. If not, we will try and answer these questions in subsequent webinars or in memos we produce or on our website. I'd like to thank everybody for attending, and I'm going to turn it over to James Kim to address our first topic.
Thank you very much, Harris. Really appreciate the time. Thank you very much for everyone who joined us today. We understand this is a critical time. We're hopeful this information that we get to you on this webinar is helpful for you to understand the PPP and the process involved. I'm joined here with my colleague, Llewellyn Engel, and my colleague, Sam Dewey, and we'll explain to you first the payroll costs, authorized uses, and forgiveness associated with the PPP loan itself. I'm going to turn it over to my colleague Llewellyn to explain the payroll costs and authorized uses.
Thank you, James. In this section, we're going to go over why payroll costs are so important. I'm sure many of you have already applied for your loan, so you've dealt with payroll costs as they've come up in the context of determining how much of your loan you're eligible for. But payroll costs also are going to come up throughout the entire program when determining the allowable uses of the PPP loan and how much of your PPP loan may be forgiven, and also in when any of your forgiveness amount may be reduced. So the definition of payroll costs is just important to keep in mind throughout our presentation, especially as at least 75% of your PPP loan must go through payroll costs, and this is regardless of whether you're going to ultimately apply for forgiveness. You can go to the next slide. So what's really included in the definition of payroll cost? Section 1102 of the CARES Act defines payroll costs as salary, wage, commission, or other similar compensation. This includes bonuses, for example, the payment of cash tips or the equivalent, the payment of vacation, parental, family, medical, or sick leave, allowances for dismissal or separation, payments required for the provision of group health care benefits, including insurance premiums, payment of any retirement benefits, and then payment of state or local taxes assessed on the compensation of employees. And then in our next slide, we're going to go over what's excluded from payroll costs, which are just important as those factors that are included. The biggest exclusion is any compensation in excess of $100,000 annually, which is going to be prorated over the covered period. Treasury recently clarified that this exclusion of a prorated salary above $100,000 applies only to compensation. It doesn't apply to other non-cash benefits. So keep that in mind going forward. In addition, taxes imposed under certain chapters of the Internal Revenue Code are excluded from the definition of payroll costs. These typically include those taxes known as FICA taxes. So that will be your Social Security and Medicare taxes. In addition, any compensation that you provide to an employee outside of the United States is not included within the definition of payroll costs. And finally, any qualified sick leave or family leave wages for which your business applied for a credit under certain sections of the Family First Coronavirus Response Act is also excluded. Next up, we're going to go over some of the allowable uses in general. My colleague James on the next slide will talk about allowable uses for the forgiveness context, but these are going to be allowable uses more generally. The CARES Act expanded permitted uses of 7A loans, but it required that the proceeds of loans be used during the covered period of the Act, which the CARES Act defined as a period from February 15th to June 30th. These expanded uses are obviously broader than those that are eligible for forgiveness, but they include broadly payroll costs, which we defined on our last slide. Because the definition of payroll costs only includes salary or cash compensation up to $100,000 per employee on an annualized basis, you can only use proceeds of the PPP loan to pay any individual on that prorated amount, which comes out to a little less than $2,000. Of course, you can still compensate your employees above this amount, but you can't use the proceeds of your PPP loan to do so. As I also mentioned previously, SBA's first interim final rule requires that 75% of your loan go towards payroll costs. This wasn't as explicit in the context of the CARES Act. The language there didn't clarify it quite so much, but the SBA determined that the Act in general requires this, and that's sort of the purpose of the Act, was to compensate employees. So that is a requirement that you need to keep in mind throughout the entire period when you're using your loan. In addition, eligible uses in general include costs related to the continuation of group healthcare benefits, paid sick, medical, and family leave, as well as insurance premiums. Furthermore, you can use your PPP loan on mortgage interest payments, rent, utilities, and interest and other debt obligations. However, you have to keep in mind that these obligations had to have been in effect prior to February 15th. So for example, if you pick up a new mortgage in March, you may not use your PPP loan to apply for those March mortgage interest payments because it had to have been a mortgage that already was in effect prior to February 15th. Finally, this only applies to certain individuals who are on this webinar, but if you did apply for and receive an SBA EIDL loan between January 31st and April 3rd, you can use the PPP loan to refinance that. Finally, I just wanted to point out, and one of my colleagues will expand on this later, that we have seen lenders implementing more restrictive terms. So we just really recommend that you look at the specific terms that your lender provides you and make sure you fully understand those and take those into consideration. So on our next slide, James is going to go over those more narrow forgivable uses.
Thank you very much, Llewellyn. And so I think as she summarized, there are two periods of time we're looking at under the loan itself. Under the PPP, there are the covered uses of the loan funds. And then separately, in a different covered period, there are the allowable uses for forgiveness. So we have a different covered period as well as different permitted uses themselves. So first, the covered period itself is limited to the 8-week period following disbursement of loan proceeds. In terms of what is covered, they must be costs incurred and payments made during the 8-week period in these specific categories. Payroll costs, again, as Llewellyn referenced, only up to $100,000 on an annualized basis, as indicated on the CARES definition. So the same definition of payroll applies in both circumstances. You cannot use the PPP loan to pay any one employee more than $15,385 in salary during that 8-week period. Any payment of interest of any covered mortgage obligation, again, you cannot prepay in this case, payment, or it does, or include payment of principal on a coverage mortgage loan itself. This is defined as defined here as a liability of the borrower that is a mortgage on real or personal property and was incurred before February 15th, 2020. Third, any payments on a covered rent obligation, again, incurred before and with the rent that was enforced before February 15th, 2020. And finally, any covered utility payments, as defined here, will cover electricity, gas, water, transportation, telephone, or internet access for which service began again before the covered period As discussed, the same 75-25% rule with regard to payroll versus non-payroll costs applies to forgiveness. However, as defined here, there are less of those permitted uses. In particular, you'll note that the use of prior debt payments is not covered under forgiveness here, except for the mortgage interest payment exception listed. So you will take the 8-week period of time, take the total value of payroll and non-payroll expenses as defined here. You will take the amount of non-payroll, you take the amount of non-payroll, you'll treble that, and that is the minimum amount of salary, it's a payroll amount that you'll need in order to get that full value of forgiveness over that period of time. Next slide, please. How might forgiveness be reduced? So there's a 2-part test that's utilized here. So now you have the total value of forgiveness. In this case, you take the total amount and you can reduce it by a proportion. The first test here is what's called the safe harbor. If you restore the number of full-time equivalent employees, as well as employee pay for a pay period as of June 30th, 2020, you will receive 100% of the value of forgiveness. However, if you are unable to meet that standard, you have a 2-part test in terms of reduction of forgiveness as follows. The first is a reduction in proportion to a reduction in number of employees based on the comparison of the average number of full-time equivalent employees per month during the 8-week period. So you're taking a running average of FTEs over the 8-week period against the standard that you utilize to calculate the number of employees for eligibility qualification purposes. And the 2 time periods are listed there. Second, you will see a reduction based upon salaries. So any amount of reduction in employee salary or wages below 75% of the prior number, then that employee will not be counted for the second total. And any number of employees that do not meet these standards will reduce the amount of total forgiveness by a proportional amount. So you have a percentage reduction to the total forgiveness value if you are 1, unable to meet the safe harbor, and 2, to the extent you are unable to meet the 2-part reduction test listed here. We'll go to the next slide, and I'll turn back to documentation of costs to Llewellyn for discussion of that topic.
Thanks, James. Before turning it back over to my colleagues, we're just going to go over some of the best practices in documenting the costs. So as a business, you should be carefully tracking your costs so that you can demonstrate how your loan proceeds were applied to allowable uses in order to have the documentation ready when requesting forgiveness. The CARES Act directs borrowers to include the following when applying for forgiveness. First, documentation verifying the number of full-time equivalents on payroll for the applicable pay periods that James mentioned previously, as well as documentation verifying employee salary for those applicable pay periods that James reviewed. These figures can be documented in a few ways per the CARES Act. The first is payroll tax filings reported to the IRS, as well as state income, payroll, and unemployment insurance filings. Second, if you do end up using your PPP loan for eligible non-payroll costs, such as eligible mortgage payments, lease payments, and utility payments, you should document these costs through things such as canceled checks, payment receipts, transcripts of accounts, or other documentation. As James noted, we are still awaiting additional guidance from the SBA, and the CARES Act does grant SBA the authority to require any documentation it deems necessary. So while you should be preparing all of the documents we mentioned, please also just be on the lookout for additional guidance from the SBA, as they may require additional documentation in addition to those that is strictly required by the CARES Act. So now I'm going to turn the presentation over to my colleague Lindsay, who's going to go over some of the FTE rehiring wage termination implications.
Thank you, Llewellyn, and thank you, James. As mentioned, I'm going to discuss the full-time equivalent employee numbers, regards to rehiring and wage and termination implications in connection with a PPP loan. So as James mentioned in his last slide, the CARES Act includes almost a safe harbor or savings provision that allows businesses that conducted layoffs or furloughs or even salary or wage reductions for one or more employees during the safe harbor period of February 15th to April 26, 2020, that reduction time period window, to receive a full amount of forgiveness of which they otherwise wouldn't be entitled to, provided that to the extent the number of full-time equivalent employees per month was reduced between the safe harbor window, and to the extent the salary wages of one or more of those employees who was reduced during that safe harbor window, that both of these are restored to their pre-February 15th levels by June 30th, 2020. So there's a few things important to note about this savings time period. First, it's only going to apply to the full-time equivalent employees or salary or wages that occurred during the safe harbor window. And then absent guidance, additional guidance from the SBA, that these funds will only be able to preserve the employment and compensation for employees during the covered period, as James and Llewellyn mentioned, will come to June 30th, 2020. Second, both the restoration in the full-time equivalent employee numbers and the restoration of compensation must occur to qualify for the savings provision. Just so we know that if these two restorations are not achieved, then the forgivable amount of the loan will then be reduced by these two measures. For any employee whose salary or wages was less than $100,000 in 2019, then that employee's wages will be reduced, and that employee's wages are reduced by more than 25% during the most recent quarter before the 8-week loan period, so essentially the first quarter of 2020, then the amount of forgiveness will be reduced by that amount that is above that 25%. So additionally, the forgiveness amount will be reduced. This won't be increased by multiplying the forgiveness amount by the average number of full-time equivalent employees for the 8-week loan period. And again, that 8-week loan period is going to be the 8 weeks in the time period where you receive your loan proceeds, and then divided by, at the election of the borrower, the average number of full-time equivalent employees for either the period of February 15th, 2019 to June 30th, 2019, or the period of January 1, 2020 to February 29, 2020. Just a note for anyone who has seasonal employees, only the second time period equivalent of January 1, 2020 to February 29, 2020 can be used. Next slide, please. So when we talk about the full-time equivalent employees, a lot of people ask, well, what does this calculation mean? What is a full-time equivalent employee? Because we know for payroll purposes, you included the headcount numbers of all full-time, part-time, or even temporary employees. But while the CARES Act does not define a full-time equivalent employee for this purpose, we look to other guidance, specifically our Internal Revenue Code, as well as other federal legislation, such as the Affordable Care Act, which has defined full-time equivalent employee. And based on those definitions, a full-time equivalent employee is, you count as one full-time equivalent employee, someone who works 30 plus hours a week or more, and then you add that to anyone else who works less than 30 hours a week, combining all those part-time employees, and then dividing that number of total hours worked by all part-time employees by 120. That's going to give you your number of, and add that to your first full-time employees, your average number of full-time employee equivalents. So it's essentially all full-time employees and the total number of all hours worked by less than full-time employees divided by 120, added together, and that is how you get your full-time equivalent employee number. Next slide, please. So when you're looking to have forgiveness based on re-engaging furloughed or laid off employees and eliminating wage reductions, there's certain things that we want to take into account for. So we're going to want to notify all employees within a reasonable time that the furlough will be ending. Additionally, to the extent employees were terminated or permanently laid off, rehired, you're going to be engaging new employees to maintain those workforce numbers or those full-time equivalent employee numbers. And to the extent we're eliminating wage reductions, you want to make sure that we're complying with all applicable state laws on change of wage notice requirements. Before we move on to the next slide, I just want to remind everyone that regarding the forgiveness, that's going to be reduced by multiplying the forgivable loan amount by the proportion of the employee loss. So there's ways that we can manage the number of full-time equivalent employees, and that's going to be based on structuring some rehires or also adjusting for hours worked of employees. So there's a lot of questions around in this instance. What if employees don't want to return to work because of enhanced unemployment compensation? And in this regard, there's a number of things that we can look at. So in terms of recalling employees from furlough, and if they choose not to return, technically at that time they would no longer be eligible for unemployment because that's a voluntary resignation. Now in practice, normally under normal circumstances that can be reported to the State Department of Labor, and then the State Department of Labor would make a determination based on opposition by the employer for whether or not that they would maintain eligibility for unemployment insurance. In this instance, when first and foremost concerned about maintaining workforce numbers as well as having a workforce, there's ways to also incentivize employees to come back. As a reminder, the Enhanced CARES unemployment insurance benefits end on July 31. So depending on your 8-week loan period and your cover period till June 30th, this is not going to be that much longer of a benefit towards your employees. At most, it could actually only be potentially an additional 4 weeks of unemployment through July 31. But at the same time, we can consider loyalty bonuses for employees who may have received more on unemployment, and other incentives such as meals or providing transportation, especially if employees are returning back to work in those instances and still being concerned about issues with public transportation and making sure that they have reduced risk of infections. In terms of employee restoration numbers, just a reminder, that is on the full-time equivalent count and not individual employees. So we're not necessarily having to take into account every employee that was previously let go. It's based on the average numbers. So as I mentioned, this can be used to structure rehires or re-engaging of employees and also maintaining the compensation levels by increasing hours worked or also increasing headcounts. But we're going to want to make sure that for the purposes of that calculation we spoke about before, which is going to include all full-time and then part-time employees, that you return to that full-time equivalent employee number.
Lindsay, so I think we've got a lot of questions around this. Does that mean we have to hire the same exact person back in order to qualify for forgiveness, or is it going to be a different person?
James, that's an excellent question. Based on the current guidance and the current statutory language, there is nothing that it suggests that it would have to be the same person. However, kind of in making any hiring determinations, if you're choosing not to bring back one employee over another, and depending on how those hiring determinations, or especially of re-engaging employees who were previously on furlough, you're going to want to be mindful of potential discrimination claims and disparate treatment claims. But under the current language of the statute and guidance, there's nothing that requires it to be the same employee. It's just going to be your full-time equivalent count number as opposed to individual employee numbers. So as just mentioned, next slide. So this kind of goes to James' same point. Are we looking at terminations that can be related to coronavirus only and reductions in workforce related to that, or what about terminations that were unrelated to COVID-19? In determining your full-time equivalent employee headcount, these can be we can disregard terminations unrelated to coronavirus under the current guidance. So with that, I will now turn it over to my partner, Josh Shanis. Oh, I'm sorry. I'm still going. So we have, what about special payments and bonuses and raises to maximize payroll costs during the covered period? This was something I mentioned on my previous slide. When looking to incentivize employees to return, especially for those employees who might choose to not come back to work based on receiving additional unemployment insurance, we can consider such payments as special payments or one-time payments designed to maximize the cash payments, and consider that while these activities might be technically permissible, depending on who these payments could be made to, there might be additional scrutiny. And this is going to be especially in the case for higher salaried employees, because keeping in mind the SBA has interpreted the $100,000 cap on wages for forgiveness purposes to mean that borrowers are prohibited from using these funds to compensate any employee more than the $15,385 over the covered loan period week. So these special payroll bonuses or incentive payments or wage increases are going to be best used for employees who are making under $100,000, and especially towards those who would be between that and the unemployment insurance caps with both state and federal unemployment. So based on the totality of the circumstances, you can make these determinations, and it's best to discuss with counsel. Next slide. So these, and now the next question that we're getting a lot is, what about terminations or furloughs after June 30th? So generally speaking, there is nothing in the CARES Act at this time which suggests that employee terminations or furloughs following the end of the covered period of June 30th that will impact loan forgiveness. However, just as we've mentioned in a number of points, there could be additional measures to address this scenario about if layoffs or terminations occur after June 30th, as well as some risks to reputation if you've taken these PPP loans, re-engaged workforce just for one pay period prior to June 30th, and then after June 30th, you engage in terminations or layoffs. And also under those circumstances, we'd always want to make considerations based on state and federal WARN obligations. Next slide. And with that now, I will actually be turning over to my partner, Josh Samus.
Thanks, Lindsay. Okay, so we want to talk a little bit about if you have existing credit facilities, what the impact of these new PPP loans are going to have in terms of those loan facilities and getting amendments or waivers or permissions from your current lenders to incur the loans. And so looking at your facilities, some of the facilities are going to have the ability to incur unsecured debt in the amount of the basket. So, right, we're seeing that PPP loans range from the hundreds of thousands into the low millions, and so you may have those baskets available to incur it. And even if so, it's still a good idea to speak with your lenders to specifically permit them, because there are other amendments that are advantageous that you're still going to want to explore. Even if you don't have the existing baskets in the room in your credit facility to incur this additional unsecured debt, we have still seen that senior lenders are very willing to quickly amend documents to permit this, up to either the approved amounts that you're already approved for with the SBA, or greater amounts, that may be approved in the future. So when talking to your senior lenders and amending your loan documents, from your perspective, what should you be focused on? Primarily, we think it's the following three items. First of all, you need the ability to incur the loans. So make sure that you check your debt baskets and that you increase the ability to incur up to the amount. So second, to the extent that you have financial covenants, you need to make sure that the loans are deemed not to count as indebtedness to the extent that your loans are reasonably expected to be forgiven. And so focusing on your leverage covenants, whether in your fixed charge covenants, the key is really here that you want to deem them not to be included until they're finally determined not to be forgiven. So from the outset, assume that the loans are going to be forgiven and that they won't count as part of your senior debt. At the point where it's determined that they are not forgiven, at that point, we think it's fair that at that point they would count as part of your leverage. But until that point, they should be excluded. The third point is thinking about how you should add back to EBITDA the costs that are used with the proceeds of your PPP loans. And so if you think about the costs that we've talked about so far, the forgivable costs, which are payroll, rent, and utilities, these are expenses that are going to impact your net income, but you're not going to have the typical revenue into the companies that would offset this. And so the way to think about this is that it's kind of similar to business interruption insurance, right? Where you're getting the proceeds in to fund these expenses, and they're really replacing your lost revenue. And so in a typical loan agreement, a business interruption insurance is a typical EBITDA add back to replace that lost revenue. And so here, when thinking about the forgivable PPP loans, it really is the same way, right? It's funding your payroll, your rent, your utility expense, but you don't have that offsetting revenue that you would normally have. And so to normalize the impact, it would make sense to add back this cost to EBITDA. Your largest portion is obviously payroll, so that's the focus of it. If you want to try to minimize to focus on that, it tends to be a negotiation as to, and so it's really up to you to kind of focus on your performance and what it's going to bend your impact to your financial covenants, but it's something that we think that you should be focused on. So on the next slide. So as part of these amendment requests, we're also seeing lenders request certain provisions where we do think that you as an issuer should also kind of proceed with caution. And so some of the items that we've seen lenders ask for is requiring the proceeds of the PPP loans to be used exclusively for uses that are forgivable under Section 1106 of the CARES Act. And as we've already discussed, your permissible uses of these loans are not only for uses that are forgivable. It's a broader use. And while I think the goal is obviously to maximize your forgiveness, there are other uses that are permissible. And so while it's fine to agree to use your efforts to maximize forgiveness, and that's obviously what's in everyone's best interest, you need to be careful to only covenant to that you cannot covenant to only use your proceeds for forgivable uses. The other thing, the next item is we've seen some lenders ask to take actions within a set number of days. So, for example, within 45 days after the 8-week period following the receipt of funds, that you'll apply for forgiveness. And a lot of this is based upon current regulatory guidance. As we've seen, the regulations are moving, and the regulations are going to move faster than necessarily you're going to want to go back to your lenders to request formal amendments. And so while you can always agree to apply in accordance with regulations, given the fluidity, you need to be careful not to agree with your lenders with hard time frames. It's fine to agree that you'll apply in accordance with regulations, but just be cautious about not agreeing to hard dates. And we have seen lenders almost uniformly agree not to require this. Similar to the first point, we've seen some lenders require from the outset that PPP loans are forgiven in full. You cannot agree to this. I mean, again, you can agree to apply for the maximum amount of forgiveness, but any lack of forgiveness, it cannot be an event of default. You can try your best, but at the end of the day, it is what it is, and you'll deal with the debt service you have once the final determinations are made. The last point is to be careful about really reviewing your credit documents to make sure that if there's other mandatory prepayments that would possibly pick up the proceeds of the PPP loans, for example, if you had a mandatory prepayment that dealt with extraordinary receipts or some other sort of non-permitted debt that would potentially pick this up, that you need to make sure that you address all of those prepayment provisions. And essentially, the highlight, right, is that you just need to carefully review your agreement with counsel and make sure there's no hidden pitfalls to make sure that nothing is picked up that shouldn't be, as the point of the loans really, right, is to replace this lost revenue and to make the payroll payments and the other permitted uses. So on the next slide. And just briefly on the SBA documentation itself. So we have seen, you know, the SBA documentation is not uniform. It is going to vary from bank to bank. So it depends who your actual lender is, and they're going to have their own forms. But in general, as you have probably seen, the documentation is short and it tends to be non-negotiable. We've seen a few different forms. The standard is, the most used standard that we've seen is, it's a short 4 to 5 page note. It gets sent to you in a PDF and it says sign here, and you do. What's important though is you just make sure that the details are correct. At this point, you've already applied, but make sure the application, when it gets sent back to you, is correct, and that, because you're going to be repping that at this point, the banks, your lender really does not have responsibility as to what's in that application. So just make sure that the ownership is described correctly and that the documentation is correctly and that there aren't errors. To the extent that there are errors, we don't want you to get back in line. We don't want you to lose your SBA loan number. We've seen banks that are including addendums when submitting the final package. So just make sure and double check that everything's correct. And the other item that you have to be aware of with the SBA loan documentation that Sam's going to address in the next slides is there is an issue that's driven by what happens in a change of control. And so a change of control generally under the SBA loans is a default. And so if you do think there's a situation in the next year or two, given the 2-year maturity, that there's going to be a sale, it will default your SBA loans, but keep in mind that it's only done without the lender's prior consent. And the lender here is not the SBA, right? The lender is the actual lender on record making the loan. So from a practical standpoint, it is that lender, which hopefully is your relationship lender, or maybe not, but it's that actual lender on record who will need to give your consent. Now, if consent is not given and you need to make the sale, while not ideal, you can still keep in mind the PPP loans, they're repayable at any time without premium. And so that is kind of your worst case scenario. But with that, I'll kind of turn it over to, on the next slide, to Sam Dewey, who can talk more about acquiring a business and how that works with the PPP program.
Thank you very much for the introduction. We've gotten a lot of questions of, okay, I have a PPP loan and I'm either going to acquire another business or I'm going to be acquired. And how does that fact, normal operation of business cycle, impact the existing PP loan and particularly forgiveness? And the overall answer to that is that there is some level of ambiguity regarding the legal effect of the acquisition of a business that took a PPP loan or the acquisition of a business by a business that took a PPP loan. Generally speaking, under the existing SBA regulations and informal guidance that the SBA put out as regards to the CARES Act, the only thing that really matters for PPP loan eligibility is the size of the business, be it number of employees, receipts, or alternate size standard at the time of application of the loan. And what that means is that under this prevailing reading, if you were eligible for the loan at the time you applied, subsequent events, which may include an acquisition that would affiliate you with a business that would put you over the size limits, aren't really relevant. You met the size limits when you got the loan, and you get to keep the loan and enjoy the benefits. Same reasoning applies if you acquire a business, and that again is the general reading. That said, there is a textual ambiguity in the CARES Act, which takes on a significance that I'll get to in a moment, which could suggest that an acquisition could affect eligibility for forgiveness. That if the acquisition puts you over the 500 employees, for example, or you were acquired by an entity that was over 500 employees, there may be an issue there. But again, the prevailing rule and the guidance we have received to date indicates that's not an issue. Now, there is one issue that should be flagged when considering an acquisition, either as the acquired party or as the acquiring party. And that is that under the existing affiliation rules, the SBA will give what's called present effect to future actions such as options or an intent to acquire. And there is a complicated test that's developed in the SBA and Court of Federal Claims case law regarding when an acquisition that is planned will be deemed to reach a phase such that it is considered to have occurred for affiliation analysis. And one of the things you want to think about if you're making an acquisition or being acquired down the road is, in the post-acquisition audit, will questions be raised as to whether or not that acquisition should have been given present effect under the affiliation analysis, and therefore whether you were potentially ineligible at the time of the loan. That's just something to think about, and you should be prepared to defend your position there. Now, to follow up on Josh's point, some promissory notes, as he noted, provide that a change of control is an event of default. As Josh noted, that requirement is imposed by the lending bank, not Treasury or the SBA. So it's the lending bank whose consent is required to close the acquisition. And it is possible that a lending bank may refuse to give consent if they are worried about the legal ambiguity I mentioned earlier. They may just take the road of saying, it's cleaner for us not to get involved. And the final cautionary point I'd make about making an acquisition or being acquired is consider the media, reputational, and political considerations. You may be applying for forgiveness in a situation in which you're no longer a small business, and that can have consequences. We've seen news articles earlier today criticizing entities that were perfectly eligible to take funds, but were large businesses and got in because of an affiliation exception. And that provoked media backlash. Next slide, please. If you do acquire a business with a PPP loan, or you're acquired, the most important thing is to think about minding your accounting to avoid endangering your loan eligibility or an opportunity for loan forgiveness. And that is, consider using segregated bank accounts, carefully maintain accounting at the PPP business level. And that leads into a broader point, which is that, as Llewellyn and James discussed, we don't have full clarification on forgiveness. There is ambiguity in the statute. One of the potential points of ambiguity is that if your merger or acquisition is structured in such a way so that the company applying and then receiving the PPP loan no longer has a legal existence, it's almost impossible to figure out how would you calculate forgiveness or even permissible uses if that company ceases to exist, if you don't have a payroll, if there's no metric on which to judge whether or not employees who had been furloughed or laid off were brought back. So in that regard, if you are contemplating a transaction, we recommend thinking structurally. How do I structure that transaction, even if it means a multi-part closing or a delay, to allow the corporate form to exist to take advantage of forgiveness and permissible uses of the funds? Another question we've gotten a lot is, if there is an acquisition, can PPP funds then be used towards acquisition-related expenses or even expenses such as payment of the payroll of the acquired entity? Again, there's legal ambiguity here. You can make good arguments both ways. It's our recommendation that you avoid using PPP funds for those purposes because the substantial legal ambiguity raises questions about forgiveness. Next slide, please. If you have received a PPP loan, you are still eligible for other relief, most notably the lending facilities that the Treasury and the Board of Governors of the Federal Reserve has established under Title IV of the CARES Act. You are eligible if you have, quote, not otherwise received adequate economic relief in the form of loans or loans guarantees provided under this act. We expect that test to be implemented liberally and to be based on a self-certification. So if you took a PPP loan, you can apply for these programs. And the programs that we would expect would have most interest would be the board's Main Street lending facilities. There are two. The Main Street New Loan Facility, which is designed to provide a new loan to smaller mid-sized businesses, or the Main Street Expanded Loan Facility, which is designed to create an upsized tranche on existing loans to smaller mid-sized businesses. I said smaller mid-sized. Under what we know about these facilities, that means anyone under 10,000 employees or under 2.5 billion in 2019 annual revenues. Both of these programs would require compliance with certain leverage ratios. The new loan facility has a leverage limit of 4 times EBITDA. The expanded loan facility limit is 6 times EBITDA. Now, we don't know how EBITDA is going to be defined in this context. We're awaiting clarification. Now, these are the programs that come with restrictions on share buybacks, stock distributions, and executive compensation. Those all would apply to these Federal Reserve programs. Those limits don't apply to the PPP program. We don't expect these loan facilities to come online for several weeks. And as I mentioned, key details of the facility are unknown. We expect them to be defined via regulations, FAQs, and form transaction paperwork. But that's a preview of coming attractions, if you will. And again, you are probably eligible for these loans if you've already gotten a PPP loan. Next slide, please. I'm now going to turn it over to Ander Liezos to discuss special tax and planning considerations surrounding these loans. Thank you.
Thanks, Sam. Next slide, please. So we're going to spend a few minutes on some special tax considerations. There is a very unusual provision in the CARES Act, and typically under general tax principles, a loan that's forgiven is taxable income. For federal income tax purposes, that is not the case here. There's a special provision that says to the extent that the loan is forgiven, there is not taxable income. Now, there's one important caveat to that to keep in mind, and that is not every state is going to follow the Internal Revenue Code on a real-time current basis. Some states follow the Internal Revenue Code on a rolling or automatic basis, like New York. Other states, like California and Massachusetts, for example, they only follow the Internal Revenue Code as a fixed stated point in time. And yet there are other states that follow different parts of the Internal Revenue Code as of different dates. So you really have to understand the state you're in. And I want to come back to that as potentially a planning point later, but that's something important to keep in mind. Now, in terms of the value of the overall PPP program, one of the things that I think many assumed out of the box is, gee, if I'm paying for compensation, if I'm paying for rent, if I'm paying utilities, those are costs of doing the business, I should be able to get to deduct them. And unfortunately, there is some real confusion on that issue. I won't bore everyone with all the technical niceties of the argument, but generally, there is a provision in the Internal Revenue Code, so-called Section 265, that generally talks about disallowing deductions when amounts come from a tax-exempt source of income. We think there are arguments to the contrary to be made there in terms of the fact there's no certainty that the loan is going to be forgivable. It takes action by the individual to actually make a loan to be forgiven. And then there's also the fact that during the S&L savings crisis in the late 80s, there was similar provisions to this where amounts that were attributable to losses were deductible, even though the government had provided holdback amounts. Suffice to say, this is a very important issue to watch and one we're going to be following closely. One professor from Cornell actually wrote a letter to Congress asking for there to actually be a legislative fix to that if that was intended. So that's a real issue. Sam had mentioned availability of other aspects of the CARES Act. Generally, in the tax area, there are a couple specific rules to keep in mind. There is a so-called Employee Retention Tax Credit, or ERTC. Unfortunately, ERTC is not available to an entity if that entity has gotten a Paycheck Protection Program loan. That part is clear. Now, there is kind of a trap for the NWRE to be concerned about, and that is when you look at ERTC eligibility, you just don't look at the entity that applied for the loan. You look at all of its affiliates, and suffice to say, there are a very complicated set of rules that apply to figure out affiliate status. And it's not the rules that just apply to your tax qualified plans. There's a lower threshold for control that's used. So if there's any connection between an entity that took a loan and an entity that you're thinking about this retention credit for, you really have to do the analysis to find out if there's eligibility. The last tax point I wanted to just briefly mention is the payroll tax deferral opportunity. And basically, without getting into all the details, what the rule says is that basically you can take amounts that would otherwise be remitted to the federal government as payroll taxes and pay them half at the end of 2021 and half at the end of 2022. Now, there is a wrinkle for employers that have taken PPP loans, and basically, instead of being able to use that possibility for all of 2020 payroll taxes, you can only use it up until the time the loan is forgiven. So one of the things to keep in mind is what that forgiveness date is and how that relates to the payroll tax deferral. I'll just say really quickly that this payroll tax deferral is a nice option, but it is just a deferral. It is not like PPP loans where you can qualify for forgiveness. This is an amount that will have to be paid. So let's move to the next slide. All right, special planning considerations. One of the things that is quite remarkable from looking at the questions that have been sent so far is that there's a fair amount of sophistication on dealing with expenses around the edges. There's a fair amount of ambiguity in terms of how to draw the lines in terms of what is in and what is outside of the 8-week covered period. And I want to just go through a few concepts with you really carefully or quickly. So one real basic question is, does it take an expense to be both paid and incurred during the 8-week period? Or is it enough to just be paid regardless of when it was incurred, or to have it be incurred regardless of when it was paid? There's not really, the language certainly is very clear on that point, unclear on that point rather. And if we've learned anything over what's happened over the last few weeks with the Paycheck Protection Program, I expect there to be FAQs and amendments to the interim final rules and some probably twists and turns that we're not going to expect. It's fair to say that one of the things that you really should be doing is identifying those expenses around the edges. And as we go, we'll try to address some of those questions before we leave today. The other aspect is, when is an expense incurred and when is it paid? And that's not obvious either. There was one question that I saw that talked about, can you use GAAP for this purpose? Right now, that seems to be certainly a reasonable good faith position to take, but that's certainly not in the statute, and it's not in really any of the rules. In terms of expense, the question on expense is, geez, if it's going to have to be paid, what constitutes payment? Does that mean you're paying in cash? Does payment mean you're giving a promise to pay in the future? Can you put something in an escrow account? What is the line that you have to cross in order for there to actually be a payment? And we're going to have to wait and see where that comes out. Lindsay had mentioned earlier, the opportunity of making special payments or special bonuses. Have seen a lot of interest in that. It is a viable strategy. So if somebody actually is employed and they haven't really received up to that full $15,000 in change during that 8-week period, there is a possibility of making that up. And one of the open questions is, do we have to actually deliver cash within that 8-week period? Or is it fine for us to say, well, we're going to deliver that to you later point in time and put it in a segregated account or something like that? Clearly, one of the things you're going to want to watch is what these accounting rules are for what fits within the 8-week period so you can structure your bonus arrangements. Similar accounting question plays out in terms of prepayments and back payments. Questions in terms of lots of lease payments that that are outside the 8-week period that may have been due in February or March, and is it enough to just be paid during the 8-week period? That's an open question, but certainly one can look at the statute and think it's either paid or incurred, but we'll have to wait and see how that plays out. Lindsay also went over, remember these terminations, it's a very critical planning perspective. Unless we get some relief in terms of an amendment of the statute or some liberalized rules on the reductions, you really need to think through when those employment rehires are going to happen to maximize the amount of the loan forgiveness. Another question that we've gotten quite a bit is, well, geez, I'm not ready to, I don't need all these employees now, and the 8 weeks starts when I get the proceeds. Can I just delay the proceeds for another month? I've gotten approved. This is great. I haven't gotten the money yet. Let's get money in May instead of now. And unfortunately, what SBA has said is that there's a delay period of no more than 10 days of getting those loan proceeds. So unless they make a change later by statute or regulation, there's not much flexibility there. Last slide, please. So kind of what's to come and what do you do now? So basically, as was alluded to earlier, there's going to be, in all likelihood, additional funding of PPP. And the question is, will there be some changes that come along with it? Two changes that have been proposed and pushed are eliminating the 25% cap on non-payroll expenses. If that were to be allowed, that would be a tremendous, tremendous benefit and ease a lot of the complications of trying to figure out how to fit compensation within this 8-week period that was alluded to earlier. And the other one was maybe getting another half month of loan proceeds, although given how popular this program is, it's hard to really see that that's going to work. I think many of us were very, very hopeful that these headcount and wage reduction rules would be eliminated or substantially simplified. It's hard to say how the purposes of the statute aren't being met by just incurring these costs within the 8-week period without all of the traps for the unwary as to when that headcount reduction or headcount increase needs to happen and how you maneuver the employees in and out of that 8-week period. Unfortunately, it looks right now like we're not going to get some of that relief. So I think it's fair to assume that what we're going to see are a lot more FAQs, a lot more changes to interim rules, where a lot of the questions that are being asked today are going to get addressed in one way or another. And unfortunately, what we've seen so far is very piecemeal. So what do you do now, given that the rules are to some degree in flux? the first thing that you can do is you can identify all potential covered expenses. Sort of the traditional red light, green light, yellow light analysis. There are certain things that we know for certain are going to be covered. There are certain things, particularly in terms of expenses around the edges, we're not sure of, but are qualified. Those are yellow. There are certain expenses now we have complete clarity we can't deal with. So if you have green light expenses, if you will, then let's go ahead and start paying those once you get the loan proceeds. If you have things that are red light expenses, well, to what degree can you push them off and not use the loan proceeds for those? And the ones that are, you know, the sort of yellow lights, make decisions on those week period, because, you know, it may be that some of them won't count, some of them will count. And all that matters is that you spend within the 8 weeks. So while we don't know all the mechanics of how the calculation with the reductions is going to work, we certainly can plan to at least that level of detail. So basically then, one of the other questions, okay, we've spent now for the 8 weeks, when do we go in for our loan forgiveness? Because remember, we don't have, okay, any interest on this loan we don't have any payments for the 6 months, and the interest charges are only 1%. And so, gee, we're going to get a benefit in terms of payroll costs because we don't have to pay the payroll cost until the end of 21 and the other half until the end of 2022. Does it make sense to maybe go for forgiveness a little bit later to get more payroll savings, or does that not make sense? And then another factor to sort of consider is, what is your state doing in terms of getting loan forgiveness? Is it going to be only loan forgiveness after a certain date, or will any loan forgiveness for conformity with the Internal Revenue Code be retroactive to when the loan was taken? We don't know how that's going to play out, but in the next couple months, you should be watching in your state, if it doesn't do automatic conformity, how they're going to deal with that issue. And then, you know, probably the most important thing as a takeaway that you can have is really understanding the trade-off that you're going to have between increased payroll costs and the loan forgiveness amount. If you have non-payroll costs, okay, that are going to be much more than 25% of the loan, you have to understand that by increasing those payroll costs, you're going to be getting forgiveness to some degree on the non-payroll costs, because the entire calculation is being uplifted. And so that's really a critical thing to understand as you think about onboarding individuals. And so really our message is, I'm sorry, I think my system went off there for a second. What I was trying to say was, again, to be strategic about thinking about how to bring the employees back and figuring out how and when to spend the money so you can get the maximum amount of the loan forgiveness. And really, even though the rules are still in flux a little bit, now is really the time to start planning for that. So with that, I'm going to hand the baton off to Harris, and I think we're going to address some questions.
Thanks, Andrew. And we've received 108 questions, which maybe is a record for one of our webinars. And I think we've addressed many of them just in the presentations. And I will turn it over to James in a minute to see if we can answer a few as we are over time. But just on a housekeeping matter, this presentation has been recorded and will be placed on our website, mwe.com, and our COVID-19 Resource Center. So everyone who wants to access it can and rewatch it. It will be up in the next day or two. Also, our list of upcoming webinars is also listed in our website. So here are some of them for your review. And again, please visit our website. As you will see, we have webinars each and every day on the topic. But let me turn it over to James to see if in our last few minutes here we can address some of the consistent or grouped frequent comments we've received and questions during the presentation.
Thank you very much, Harris. And as the head of the groups at the firm's SBA Loan Task Force, we have a group of individuals fully tasked to investigate these questions. We'll try and address everything that we've received after the call, but we'll get to a couple of them very quickly. One of the questions that did come up a couple times was whether or not for the 75%, 25% payroll versus non-payroll expense requirement, whether that requirement was applicable to the loan value as well as the forgiveness. And the answer is yes. And I'll briefly transition to my colleague Llewellyn, who will point to the specific quotation from the IFR.
Thanks, James. Yeah, so we saw in both SBA's first interim final rule as well as their third interim final rule that the SBA clarified that this 75% number applies beyond just the forgiveness context. So it's come up a lot in forgiveness, and I think that's what many people have been focusing on, but the SBA does say, and I quote, as with similar limitations on the forgiveness amount, and then it goes on to highlight that 75% payroll requirement. Similarly, in the third interim final rule, one of the questions is whether there are restrictions on how PPP loan proceeds can be used. And the SBA clarifies that yes, at least 75% of the loan proceeds shall be used for payroll costs. So while it's often brought up in the context of forgiveness, you should keep in mind that that limitation applies generally as well.
And I think, Llewellyn, the implication of that is once you obtain your loan proceeds, if you're not able to satisfy that requirement, that those proceeds should be returned when you realize they can't be used for that purpose.
Correct, and SBA clarified that in their first final rule as well. They said, you know, what happens if we can't do that? And they say, what happens if the funds are misused? And a misuse in this context would be using your loan proceeds for the amount that's different than that 75%. So for example, putting 50% towards rent or utility costs. And the SBA clarifies that if you misuse funds in that way, then the SBA will direct you to repay that amount. And so that's not your entire loan. It's just the repaying the amount of the loan that's been misused in that context.
I know another question that's come up regarding to the actual use of forgiveness, the forgivable uses with a loan amount that's 2.5 times the average monthly cost. It'll be difficult to use the proceeds for strictly forgivable uses. I think that's related to the question that Llewellyn answered right there. One, you are not restricted to the forgivable uses for permitted uses of the funds. If you cannot fit within the permitted uses of the funds the full amount of loan proceeds, the expectation is you may be required to refund that excess loan balance depending on the specific circumstances there. I know we have a number of other questions, but we are running close to time. Do we want to run through a few more, or is there anything, or do we want to call this?
And why don't we take two more, James? No,
Absolutely. So I know that we had a question for our colleague, Lindsay, which stated that for any reductions in forgiveness, can you confirm whether the terminations due to reasons other than COVID-19 will be counted in the FTE calculation? And is there a guidance on that you can point to?
Sure, James, thank you. So as I addressed, and also as Andrew touched on, the most important aspect is going to be the timing of these terminations. But in terms of looking at the intent and guidance of the statutory language that we received in terms of maintaining workforce numbers in connection with reductions in force related to COVID-19 or coronavirus, we can take from that essentially terminations unrelated to coronavirus, whether it might have been terminations for cause or voluntary terminations by employees outside of those safe harbor windows where you can bring back those number of employees based on proper documentation that you can submit ultimately to your lender, who will have the ultimate determination of whether or not you've brought back those FTE numbers based on severance communications, written communications, termination letters to support the position that those employees who were terminated or let go voluntarily resigns as well that did not come back on for non-COVID relating reasons would not affect your FTE headcount. Also, but just keep in mind for the most part, and this goes to the question we spoke about during the webinar, that is it an individual basis? Again, it's not. It is all based on FTE headcount. So that's going to be your total number of hours worked by employees. So as mentioned in terms of bringing some employees back, not bringing others, making hiring determinations, including increasing potential hours worked. It's all ways to structure your workforce numbers such that your FTE headcount or FTE number employees, full-time equivalent employee numbers, maintain those same windows as your pre-loan numbers. So there's lots of ways to work around that.
Thank you. And I guess the last question we'll take is a question that came up earlier with regard to the forgiveness side of the equation, whether or not healthcare payments are permitted for forgiveness separate from that under the permitted uses. And as we stated, it's the same definition, but Llewellyn, can you please confirm that it is permitted for that purpose?
Yes, James, we can go back to the slide that defined payroll costs. And so the definition of payroll costs is a little bit broader than simply salary, wages, or other similar compensation. But the definition of payroll costs also includes family medical sick leave and then payments required for the provision of group healthcare benefits. So when that definition comes up in the forgiveness and general use requirement, you can roll into that reference to payroll costs, all those different factors that went into the definition.
I want to thank everyone for participating in this webinar and thank all the panelists. I think as shown by now, we're up to 119 or 122 questions. This is a very informative discussion, and we will try and get answers to all these questions posted on our website. And thank you again. And hopefully there'll be more money put into the program so more people can participate. Thank you again.